everyone, welcome to Policy Watch, the show where we bring you the week's biggest financial stories and also join the dots to unravel their impact. I'm Surabhi Upadhyay. This week we discuss the big US taper as the United States starts to roll back its loose money policy. Emerging markets go into a tailspin. Will India survive this storm this time? We also look at monetary policy back home, where the RBI chose to surprise the market yet again with a rate hike. And finally, with so much economic uncertainty around, should India be looking at easing the import restrictions on gold? Well, first up, taper talk. As the US Federal Reserve announced yet another $10 billion reduction in its bond buying program, emerging markets saw massive risk aversion this week. Tapering, coupled with weak Chinese growth numbers and political turmoil in countries like Turkey, is making investors nervous. The question now, is the worst of this capital flight behind us, or is this just the beginning?
The US Fed is slashing its bond buying program, and the emerging markets are feeling the heat. Currencies have weakened in Brazil, Turkey, South Africa, Mexico, South Korea, Argentina, and India. In order to deal with its rising unemployment and provide enough liquidity, the US Fed has been buying bonds worth $75 billion every month. But now that employment figures are showing improvement, it is now cutting back on spending by nearly $10 billion a month. The decision evoked an instant reaction in the emerging economies. Reserve Bank Governor Priya Ranjan urged greater coordination among central banks to deal with the slowdown. India, however, said US decision was on expected lines and wouldn't affect markets. A finance ministry statement said India's economy is better prepared for consequences, if any, of the taper. We have added to our foreign exchange reserves, which stand at $295 billion. FDI and FII inflows continue to be robust, liquidity is comfortable. Analysts are pointing out the bright side. They say the tapering signals strength in US economy, which is good for export-oriented companies and macro fundamentals. Bureau Report, Rajya Sabha TV.
Joining us now to discuss this is senior journalist Priya Ranjan Dash. Mr. Dash, it's great to have you in the studios. Thank you for taking out the time to be with us today. So, a couple of important issues to discuss. It's been a very dramatic week for markets pretty much around the world today. And a lot of it centered on the US Federal Reserve. I guess that's the genesis. As the US is looking at rolling back this massive amount of money that they were printing out, the world is worried. Should we be worried in India?
Well, one thing good about this time is now our calendar is fixed. So what has happened is another additional $10 billion, not additional but less, of bond buying by the US Federal Reserves. So to that extent, markets are prepared, especially in India, to a large extent. So it's unlike the last time around when it came as a bolt from the blue. This has been quite predictable, and I guess it's already been discounted by the markets.
Mm-hmm. Well, you know, the numbers are still not looking scary. I was looking at the flows details. When the rupee in August last year hit about 68 and the panic was at its peak, we were losing almost $2 to $3 billion a month from our equity and our debt markets. Is there reason to believe that that will not happen this time? Right now, we're still net positive for the month of January. Equity, there's a very paltry inflow, and debt, we're still, despite the outflows, we are still positive for the month gone by.
See, the prospects of tapering alone wasn't responsible for that precipitated fall in rupee. Rupee was in fact correcting itself. I believe that the fundamental reasons why the rupee took that kind of a tumble was because of the high or the hyperinflation that we have had domestically. So rupee was merely adjusting to the high domestic inflation compared to the inflation that was prevalent in our trading partner countries. So that was the primary reason for the rupee tumble. Now rupee having adjusted itself to a certain level now, and a predictable calendar of tapering that is happening, $10 billion a month. Now, clearly, I don't see rupee coming under that kind of pressure because of this factor.
Mr. Arvind Mairam made a statement this week saying that we are very confident that the current account deficit situation will be under control. And he gave some figures, I think, looking at reducing it to 2.5% of GDP. Should we believe the government functionaries and the government machinery when they say that all is well, or at least all is a lot better on the external front?
Both the Reserve Bank of India and the government have done their mathematics, and it's a mathematical truism that the current account deficit would be contained below 2.5% this time. So, which is a commendable stabilization compared to last year, for instance. But that stabilization has been brought about by import compression. What is happening, as we know, there is an industrial recession. We are officially or even technically, we are in a recession. So, that being the case, the import demand of import of inputs and intermediates, or even machineries for that matter, that is not taking place. So, there is an import compression even in the so-called merit good import. Then you have had certain import compression which has been achieved in the non-merit good category, which imports which were not so desirable, for instance, gold and
Sure.
So and the oil prices have remained relatively stable,
Calm, yes.
So that has also contributed.
Right.
But a positive, sustainable kind of current account deficit reduction can only be achieved if your exports are doing well.
And that's the question mark right now. No, before we wind up this part of our chat, just a quick word on this whole timing. As the US pares down its massive stimulus, we are in election mode. Over the next couple of months, we'll know who's going to be running the country. I just want to understand from a financial market standpoint, or the way foreign investors are viewing a country, how crucial do you think this will be? Do you think the election outcome will have a bearing on how foreign investors view the country, and therefore the kind of hope, the flows that we can hope to garner?
Sure, so far as the markets are concerned, or even for that matter, foreign direct investment is concerned, the election is a big news event that everybody is watching. And insofar as policies are concerned too, there is an expectation that all policies would be in a kind of standstill till a new government comes and starts pursuing its own policies. So there is a certain amount of suspense, and I would say there is positive expectation that this government, the current government, is almost through its term, and nothing much is expected from this government, and the new government would come and it would do something positive.
Sure.
Now, so
whoever it might be,
that's a substantial risk also. So clearly, but as an event that is being watched, it's being very carefully watched. There is no denying that.
Okay. Well, on that note, we slip into a very quick break. But up next, the RBI's surprise rate hike. Was it par for the course? We continue our conversation. Welcome back here with Policy Watch. The Reserve Bank of India sprung a surprise on markets this week by hiking rates, even though the last published wholesale inflation number showed some downward respite. So what prompted this move? Here's a report.
Reserve Bank Governor Raghuram Rajan has a tough task ahead as he plans to bring down the retail inflation to below 8% in the next 12 months. A job that has become difficult due to weak currency and supply-side constraints. Rajan also discounted the growth versus inflation trade-off theory by asserting that the long-term growth can only be sustained by bringing down the inflation. He defended his decision to hike repo rate to 8% as inflation remained close to double digits.
Elevated levels of inflation erode household budgets and constrict the purchasing power of consumers. This in turn discourages investment and weakens growth. High inflation weakens the rupee. Inflation is also a tax that is grossly inequitable, falling hardest on the very poor.
Rajan said it was possible to control inflation without sacrificing the growth. While acknowledging that inflation had fallen significantly with substantial fall in vegetable prices, he cautioned that retail inflation except food and fuel products largely remained flat and wholesale prices have hardened. Referring to Ajit Patel committee report, Rajan said that the bank aimed to bring down consumer price index to 8% by January 2015 with a further reduction of 2% in the next 12 months. He said a 25 basis point hike in the repo rate was needed to set the economy on disinflationary path.
The disinflationary process evolves according to this baseline projection. We believe that further policy tightening in the near term is not anticipated at this juncture. In fact, if inflation eases at a pace that is faster than we currently anticipate, and that reduction is expected to be sustained, the Reserve Bank will have room to become more accommodative.
Reserve Bank expressed satisfaction over the performance of agriculture sector. It said strong pickup in Rabi sowing indicated that the momentum in agricultural growth would be sustained. It is expected to cool down food prices, making the Reserve Bank's job easier. RBI also expressed satisfaction over the reduction in current account deficit that is expected to come down to 2.5% of GDP this fiscal. It was 4.8% of GDP last year. Bureau Report, Rajya Sabha Television.
Well, let's take this conversation forward with Mr. Priya Ranjan Dash, senior economist who's with us. So, Mr. Dash, were you surprised? Because I was going through a market poll and some 45 economists out of 50 said no rate hike, but yes, we got another 25 basis points.
It shouldn't have been surprising actually, because see, markets and some experts get surprised because of a wrong assumption that they have been making. You see, the key assumption that people have been making is that the monetary policy is being designed to control inflation. That's a claim, of course, that Reserve Bank of India keeps making every time it tightens the monetary policy. It says that that is being done because inflation is high and we want to control it. But the fact is that the role of monetary policy in controlling the kind of inflation that we've been having of late is very limited. And in fact, Reserve Bank of India hasn't done a check on its track record of controlling inflation in recent years. There have been several rounds, more than a dozen rounds of rate hikes, since inflation assumed very dangerous proportion.
And we're still at about 10% CPI, consumer price inflation.
And every time Reserve Bank of India has targeted inflation at a certain level, it has failed to achieve it. Now, having said that, one must recognize that then why does Reserve Bank of India keeps revising the rates upwards? The pure and simple fact is, if you have high inflation in an economy, interest rates have to be high. Isn't it?
For depositors' sake.
For everybody, because if inflation is high, you have to have the money. Also, the interest rate has to be high. So that correction has to take place. Now, as long as the banks themselves are not correcting it, it's the Central Bank of India has to nudge them to correct that.
Some people were also.
So it is a reactive thing that keeps happening. So this time also there was no surprise. We know where the inflation is. We should expect a rate hike or a rate adjustment, I would say.
Some commentators were also drawing a link between the international situation we just discussed with the US, winding down its stimulus and the rate hike here in India. Would you draw any links? We know that other developing economies have been raising rates to defend themselves.
See, the link is very clear. The link again is inflation and exchange rate. When you have high inflation domestically, the real effective rate of inflation compared to your trading partners, then that adjustment has to take place. And if that adjustment would take place through exchange rate and it will take place through interest rates. You see, if you have high inflation and your interest rates for whatever reason is low, then you won't be able to attract bond investors from outside. Why would anybody be investing here?
Well, you know, it's the oldest debate out there, whether the Reserve Bank should also look at growth or whether they should only focus on inflation. And last week we had the Urjit Patel committee report as well. And now this really caused a huge flutter because everybody is wondering, now this report is saying, look at inflation targeting, look at a long-term inflation target of just 4%, reduce it to 8% next year, 6% the year after. It's anyone's guess whether this will be really adopted as a new strategy at the Reserve Bank itself. But what could be the ramifications? Should it be adopted?
See, Governor Raghuram Rajan is right. There is no trade-off between controlling inflation and growth. In fact, I would say that controlling inflation is a precondition for higher growth. So there is nothing wrong if the Reserve Bank of India, even if monetary policy is not capable of making a huge dent in terms of controlling inflation. Even if that is true, there is nothing wrong if the Reserve Bank of India tries to control inflation. In any case, its mandate has to, Reserve Bank of India's mandate is ensuring macroeconomic stability. That is interest rates, the inflation, exchange rates. If the Reserve Bank is able to do something there, then it will be aiding growth.
Are we just being shy of using the word stagflation in India? Is that not the reality that we're looking at, that growth is not happening, demand seems to be falling off, and inflation continues to be stubborn?
It is. We've been in a phase of stagflation. Means officially whether it is considered or not, but we know that there's been high inflation and no growth.
Okay, well, on that note, we take another quick break. On the other side, another interesting policy dilemma. Is this the time to be doing away with the restrictions on gold? We'll discuss India's love for gold when we come back. Welcome back here with Policy Watch. After a massive drop in gold imports this year, noises were heard this week on easing some of the import restrictions on the yellow metal. The Finance Ministry, however, was quick to clarify that restrictions would stay at least till the end of the current financial year. Let's take a look at how the numbers add up so far.
Gold importers and jewellers will continue to face tight curbs as the Finance Minister has refused to relax the duty on import of the yellow metal for now. Despite hectic lobbying by the gems and jewellery lobby, Mr. Chidambaram completely ruled out any review till the end of this fiscal, as these curbs have resulted in dramatic improvement of the country's current account deficit. Last year, India gradually increased the import duty on import of gold from 2% to 10% to deal with rising current account inflation that touched an all-time high of $88 billion. After crude oil, gold is the second biggest import by India.
Some of these restrictions are necessary. I'm confident that at the end of this year we will be able to revisit some of the restrictions that we have placed on gold imports. But let me hasten to add, we will do so only when we are absolutely sure that we have a firm grip over the current account deficit and the balance of payment situation.
India is the second largest market for gold after China. As a result of curbs, gold import came down to 19.3 tons in November from 162 tons in the month of May. Gold and silver imports came down to $27.3 billion in April to December from $39.2 billion during the year-ago period. As a result, the current account deficit in the first half of the fiscal was down to $26.9 billion from $37.9 billion in the year-ago period as well. It is projected to decline to $45 billion in the current fiscal from $88 billion last year. However, these curbs are deeply resented by gold importers and gems and jewellers as counterproductive.
For 1 kg of gold, if somebody smuggles, he saves 6 lakh rupees, 5 lakh rupees on 1 kg of gold, which is very easy. It is less than a size of mobile phone to bring it in. And every day it is happening, every day they are catching people, but what they are catching is 1 or 2%. 98% they come out. They are doing it because they come out and they are making money at the cost of legal trade.
India is the world's biggest market for gold jewellery. In 2012, Indians purchased gold jewellery of more than 500 tons. Curbs on gold imports have resulted in sudden increase of smuggling of the yellow metal in the country. Finance Ministry estimates that 1 to 3 tons of gold is smuggled in the country every month following the curbs on its imports. With Krishnanand Tripathi, Bureau Report for Rajya Sabha Television.
Well, is all that glitters that really gold? We are in conversation with Mr. Priya Ranjan Dash. So, sir, this whole point about what we were discussing on the external circuit. So, coming back to gold, because you were talking about how imports have fallen and that's why these numbers are looking so much healthier. What do you make of this whole manner in which we've curbed gold imports? And do you think if one removes these restrictions, the number will spring back up?
That is policy nonsense, actually. Means what has been attempted. Now, we shouldn't get carried away by the fact that gold imports have been compressed and so say that the policies were right. Gold, one has to basically address the basic issue. Basic issue is this kind of the gold import that has been taking place, most of it is nothing but flight of capital. In other words, it means Indians are investing abroad because we don't produce gold. We find gold as an attractive of late. I am talking about recent years. We've been finding gold as a hedge against inflation and an attractive instrument to invest. Since we do not produce gold within the country, we are importing gold. What it means practically is that we are investing outside. So, that is flight of capital. Like other investment, including some corporate investment in recent years have shifted abroad because it does not find a conducive environment to invest here. Individuals too have been, so investment demand for gold has gone up. Unless you create investment which gives positive and better return within the country, you won't be able to actually stop people from investing in gold. Making patriotic appeals etc. won't work, neither would kind of increasing the import duty or putting in administrative restrictions going to work.
But isn't this a traditional
What is happening is there is
mindset,
smuggling that is taking place.
which the finance minister has actually acknowledged,
So
saying
basically what I
1
mean
ton
to
to 3
say
tons
is
a
we
month.
are a gold crazed country, crazy country, and but we have a consumption demand for gold.
Right.
Every year festivals and marriages etc. So 800 tons is the kind of import that has been taking place. Now suddenly last year it shot up so much. Why did it shoot up so much? One has to address that basic issue. The basic issue is lack of attractive investment avenues within the country. So if you create that environment, then these kind of restrictions are of no, actually they're quite retrograde, I would say.
If the present government decides to ease restrictions in the coming months, of course it will be the new government's prerogative really to decide what they want to do. But if these restrictions are removed, is there a fear, do you worry that we'll go back to the much more uglier number on the current account deficit that we saw perhaps some years ago?
Well, if you remove those restrictions have been have not been there since the early 90s. Dr. Manmohan Singh as the finance minister was responsible in removing the gold control order, and the imports were liberalized. NRIs were allowed to bring in gold, and the import duty on gold has been reasonable. You keep the import duty at a level that you curb the economic incentive to smuggle in gold. At present rate of 10%, it's a precious metal, it's a high value commodity. On that 10% means there is a lot of economic incentive to actually smuggle in gold, and which is taking place. So officially what you see as compression of gold imports, because of the smuggling of the grey market data is not accounted for.
So let me end by asking you this. I mean, we've discussed a plethora of issues today. Finally, as you see the economy over the next 3-4 very interesting months as we head into election season, how would you describe India on a healthy scale of 1 to 10, a health scale of 1 to 10? Where do we stand, and how do you see the next financial year beginning?
Well, see, we are in difficult times. We've only yesterday you've had a downward revision of the FY13, financial year 2012-2013 GDP growth numbers. Now that is 4.5%. That is the lowest since 2003.
Yes.
Now, that means the economic conditions, and along with that, if you in the same set of data, you have how the savings rate has fallen. You also see how the capital formation, that is investment in the economy, has fallen. So, we are in a terrible state. There has been, we were in a more difficult state, or it appeared so 6 months or a year ago, and there has been certain stability which has been achieved on the external sector, on the current account deficit front and all that. But insofar as the fundamental issues are concerned, they remain unaddressed, and there are issues of structural reforms which haven't happened, and there are issues of taxation reforms. There are all kinds of, there are
pending
a plethora of issues,
Yes.
and those it's going to be very crucial. I would say that 2014 will be a make or break year for the India growth story.
Make or break here. Let's wait and watch what the new year and the new government brings with it. Thank you so much, Mr. Dash, for being with us on the show today. Pleasure to have you on. Thank you for joining us on Policy Watch. That's it for this week.